Hi everyone. Today, let's talk about the news. First up is Apple getting another stock price target increase. Apple obviously has been very strong through this downturn because their products are really not heavily affected by this. They've had a little bit of downturns from their stores closing or their production lines closing, but overall, they've been largely unaffected. Plus, they have over $200 billion in cash. Next up, GE says it won't have any positive free cash flow until 2021. But it is currently still rated a buy. They also recently authorized a dividend of 1 cent per share. And lastly, the WHO issues a dire warning about the cough situation. As always, there will be some jelly at the end, which is something I enjoyed outside of the markets. If you have big dreams like chartering the Flying Fox, or if you're just getting started on your financial journey, definitely like and subscribe. The Flying Fox is less of a boat and more of a floating mansion. It is truly the embodiment of luxury. Of course, it comes with its own boat, and if you're into scuba diving, you can do that as well. It comes with its own helicopter, and it's over 450 feet long. As you would expect, the interior is spacious and pristine. Each charter comes with a full crew as well as a private chef. To keep your dreams at the front of your mind, like and subscribe. Welcome to the Portfolio Bulletin. Let's get started. So analysts are saying that the current price for Apple is too low. They raised their target up to $405 from $370. Keep in mind that the current price of Apple is below $350. It closed on Friday at $347.07 in aftermarket trading, which means there's definitely potential for upside. It says here a lot of the growth is currently because of their services as well as their wearable business, but some say the primary driver is the upcoming arrival of 5G phones. They say here they're confident in Apple's ability to maintain retail pricing for the fall launch of 5G phones, as well as their gross margins. Of course, this makes sense. Apple has been one of the leaders in the cell phone industry, and it makes sense to assume that they will be one of the leaders in 5G once it fully arrives. They go on to say that foot traffic at AT&T, T-Mobile, and Sprint are back to 75% of their pre-cough numbers, and 54% at Verizon, and 32% at Apple's own stores. Of course, Apple gets better margins at its own stores when they sell direct, so it is important to reopen those stores as soon as possible. They go on to say that Apple suffered a setback as some of their stores are reclosing in the United States due to the cough situation reemerging. I've said this several times at this point, but I don't think the government is going to come down and close business. I think it's businesses that will close businesses, or maybe customer confidence, but not the government. It says here they expect 5G pricing to be largely consistent with iPhone 11 levels, and that the new technology might cut into their margins a little bit, but they believe that Apple can find ways to reduce the costs. Going back to Apple's cash pile, this chart shows how much money they've had over the years. Looks like Q1 of 2018 was actually their highest point for the amount of cash they had, almost $300 billion, and they've actually been whittling it down to the $207 billion that they currently have. To quickly go over the Morningstar projections, Morningstar only gives Apple 2 stars, and they have a current fair value of $279. So currently, Morningstar thinks that Apple is overvalued and that they don't see them growing up to the $400+ mentioned before. If you look here, you can see that the projections are basically flat through the end of 2020, somewhere around the $350 range, but it does project up to a little bit over 400 or down to the fair value of 280. To summarize all of this, 5G is going to propel Apple to new highs, and I think they will meet their new price target of over $400 per share. Moving on to General Electric, the CEO Larry Culp announced on May 28th that they don't expect to generate positive free cash flows until 2021. So the amount of cash that GE is burning is definitely concerning. GE expects to burn between $3.5 and $4.5 billion in free cash flow during second quarter, which is already higher than the $2.5 billion that analysts expect. So altogether, for first and second quarter, they're expected to burn $6.8 billion in cash, which is definitely not good for a company that's already struggling. And all of that has caused the CEO to come out and say that free cash flows are going to be negative for 2020. It says here that the companies that GE sells engines to have reduced their production schedules for 2021 and beyond. While cost reductions might be able to reduce free cash flow outflows, they cannot completely eliminate them. The cough situation has generated unfavorable conditions for the aviation market, and because of that, General Electric is only a reasonable stock for long-term patient investors. Short and mid-term investors should definitely stay away from it for right now. And to top that all off, the leader of the aviation division has announced his retirement. While a leader leaving doesn't always spell demise, it's not great to bring in a new executive during this period. Next, this article talks about how share price will not be harmed by the downturn in free cash flow, and it cites the fact that GE stock has moved sideways since May 28th. The article goes on to cite that Bank of America has an $11 price target for GE, and it expects a $1.5 billion free cash flow through 2022. And most of this is because of their aviation department. The author does not agree with Bank of America's assessment. He says until we are virus-free, GE is not the kind of stock that you want to own. It will take multiple years for the business to recover, and it's pretty hard to fix a business during an economic downturn. Despite all of that, they have authorized a 1-cent dividend per share, and that dividend is payable on 27 July. To quickly go over the Morningstar report for General Electric, they currently have a fair value estimate of $9.77, so not quite the $11 that was mentioned, but they do think it is currently undervalued. If you look here at the projections, they see a price somewhere around $11 by the end of 2020. Personally, I'm pretty torn on the topic. It's a little strange to me that a company that seems to be facing so many headwinds did just announce a 1-cent dividend. It seems like they would need that cash to prop up some of the different arms of their business. While their aviation sector is very good, along with their healthcare sector, their finance sector is not doing as well, and neither is GE Power. Maybe there's something that we don't understand as investors that they feel they are comfortable to announce a dividend, and that gives me a little bit of hope. So if you are in the business of maybe holding this stock for 5 to 10 years, then I think GE is definitely a buy for you at this time. If you're looking for anything less than that, then I wouldn't buy it. All right, so the last thing is the cough situation. The WHO came out and mentioned that we are entering a dangerous phase of the Rona. But as this article says here, many people are fed up with staying at home. Countries are eager to open and are opening probably faster than they should, and the virus is still spreading. They had the most reported cases in a single day at 150,000. But to be fair, I think 50,000 of those were in Brazil. And then they issue a word of caution to all world leaders against the virus. Even after all this, I still don't think that the world economy is going to close down again, mainly because we can't afford it, but also I just don't think people are willing to do that at this point. We may save some lives if we shut down forever, but the downside to that is immense. And for that reason, even if we see a pretty large uptick, I still think the economy is going to stay open. To be clear, I am long Apple stock, and I do think it will go over $400 per share. I don't currently own any GE stock, but I am looking into buying some. Especially after I saw some of these reports, I do like to buy companies that have been downtrodden, but still have a pretty good means of making money. You can't buy cheap stocks in companies that are doing really well. For example, Apple is doing really well, but their stock is also very expensive for the amount of money that they make. And then we have the Rona. It's coming back a little bit. We're testing more than we ever have, and we're also opening up the economy. But I'm just not sure anyone really cares about this anymore. Definitely like and subscribe if you got any value out of this video. Let me know down below if you think Apple or GE are good buys right now, or what you think is going to happen with the cough situation. Of course, this is not financial advice. This is for entertainment purposes only, and please consult your financial advisor before making any decisions with your own money. And with that, let's get to the jelly. Today's jelly is Jiggly Boy. He's a diehard Timberwolves fan, and he is clearly a huge fan of KG. So here's a little bit of his evolution from 2003 to 2015. This dude clearly has a lot of confidence. And they gave him a free jersey.
for you to show us your moves. Let's see your dance moves. What do you got? Go back there. Come on. Okay. Let's do it, baby. Let's do it. Somebody else. There you go. Show us your moves. Let's see what you got. Try.
You certainly have to respect the man's love for the Timberwolves, and he definitely loves KG, and honestly, he dances pretty well. I mean, I respect it, for sure. Let me know what you think of his dance moves down in the comment section. Make sure you hit the bell so you don't miss any of my future videos, and have a great day.